Hello again, and welcome to the third tutorial on interest rate sensitivity. In the first and second tutorials, we focused primarily on how to measure interest rate sensitivity. We looked at PVBP, the price value of a basis point, and both modified and Macaulay duration. In this tutorial, we extend and apply these measures. We introduced DV01, the dollar value of an O1 or 1 basis point, which measures actual dollars at risk. We look at how to calculate a portfolio DV01 and portfolio duration, and how to implement a hedge on a position. So first, how are these duration types used? Well, they can be used to measure the interest rate risk for more complex positions, such as a bond investment portfolio, a trading position with longs and shorts, or a full balance sheet that includes assets, liabilities, and derivatives. They can be used to identify the correct hedge to reduce or eliminate interest rate risk on an investment position, simple or complex. They can also be used by issuers wanting to hedge interest rate risk in an upcoming debt issuance. And finally, there are more advanced duration measures that can be used to manage risks to non-parallel rate moves, something called key rate duration, or to changing credit spreads, something called spread duration. We will not be looking at these two measures in this tutorial. So let's start with DV01. What is it and why do we need it? DV01 is the dollar value of 1 basis point, and it's like PVBP, but it applies to the whole position. So remember, PVBP measures how much price changes for a 1 basis point move. DV01 measures how much we gain or lose in dollar, euro, yen, or other currency terms from a 1 basis point move on a bond or more complex position. PVBP is expressed as a percent of face. DV01 is measured in dollars. For one bond with face value of 100, DV01 equals PVBP, but in general, DV01 is the PVBP scaled up by the total face value held, and we'll see how that is done precisely in a moment. For a portfolio, DV01 is the sum of the DV01s across all holdings, and we'll look at that as well. And if you're constructing a hedge, you want the DV01 on the hedge to exactly offset the DV01 on what is being hedged, so that the net interest rate risk will be reduced to zero. So let's first recall how we calculated PVBP. You may recognize this example. This was an example we used in the first tutorial on interest rate risk. And it's a 10-year bond with a 10.5% coupon, a price of 125. And we'd calculated the PVBP using this method right here. We essentially shifted, we calculated the yield of 6.9490. We had to retain the precision, so we didn't re-enter anything. We subtracted 1/100th of a basis point so that we can make a precise measure. We re-input that, we put that back into the IY field and recalculated the price, and we got the 125.0008, and it's actually more than that, it goes out to other decimal places. We subtracted the original price, and we multiplied by 100 because we had done the shift of 1/100th, and we want the shift to be for 1 basis point. So that's how we got our 0.0820. Now, how would we use this to calculate the DV01 on a position holding this bond? So for example, if we had $100 face of this bond, it would have a market value then of $125, and the DV01 would be 0.082, essentially the same as this, but in dollar terms, 0.0282% times $100. And if we had $1,000, it would be the same calculation, but for 10 times larger amount. So the DV01 would be 10 times larger, or 82 cents in this case. And multiplying by 10 again to $10,000, we get to a DV01 of 820. And if we had a face value of 20,000, it would be twice that. So it'd be 1640, representing 0.0820% times 20,000, giving us 16.40 as the DV01. Now, we could use this to estimate the loss on a small shift in interest rates. So for example, if we're looking at a 25 basis point yield to maturity rise in this bond or this position, we would just multiply the DV01 times that 25 basis point and we would get the loss. So in this case, it would be $2.05 on our $100 face position. But if we would go out here and we were looking at the $20,000 face position, it would be 1640 times that 25 basis point move, and that would give us 410. Now we could go back and calculate directly the new price based on that 25 basis point change by adding 25 basis points to this yield to maturity, recalculating the price, looking at that price change and then multiplying that by the face. And if we were to do that, we would get these figures, 203 up to 405. And as you can see, for a small change, 25 basis points, these two are pretty close. Now let's say we had a portfolio and we had a second bond. So we have a two bond portfolio here. The first bond is what we just looked at. And we had a new position, $30,000 face invested in a 10-year bond with a 4% coupon and this price. So that would be the face value of the investment. The market value would be its price, 78% times 30,000 or 23,400. And the DV01 would be this 30,000 times the PVBP of that position, or 1788 in this case. And so for the portfolio as a whole, we can summarize by adding across the columns. So we now have a portfolio that has 50,000 face, 48,400 is the market value, the sum of these two. And the DV01 for the portfolio is 3428, again, the sum of these two. And that represents what the portfolio would gain or lose for a 1 basis point shift in both of the bonds in the portfolio in the same direction. Now we can calculate this at the individual bond level, so we can look at what we would gain or lose from a 25 basis point move on the first bond, for the second bond. But we can also do it for the portfolio as a whole, either by adding these two or doing it directly, because we have the DV01 of the portfolio. So we could multiply that 3428 times 25 and we get 857. And as we see here, that actually is very close to the actual loss that we would incur, which would have to be calculated at the individual bond levels and then added together. Now, this technique can be used for a portfolio of any size. So let's just add two more bonds to see how that works. So if we add a third bond, 15-year 9% bond with this price, and a 7-year 0 with this price, and we buy 20,000 face and 50,000 face respectively of these two bonds, these would be our market values, and these would be our DV01s. Again, the DV01s would be the PVBP times the face in each case. And then the DV01 for the portfolio would be simply the addition of all of these individual DV01s. And then if we wanted to estimate the loss from a 25 basis point rise on the whole portfolio, we don't need to do it at the bond level. We can take the 7465, multiply it by 25, and we get 1866. And if we compare that to what we would get if we did precise calculations for each of the bonds, recalculating their price based on the shifted yield, we see that, again, we're very close, as we would expect for a small move like 25 basis points. Okay, so what we saw is that if we have the summary measures, we actually can do the sensitivity analysis for these parallel rate moves. So here we have our portfolio. It happens to be 4 bonds, but it might be 400 bonds. We don't know what's included in it, but we do know that the total face is 120,000. The total market value is here, 102,900, and the DV01 for our portfolio is 7465. So using that, we can estimate the gain or loss from a fall of 50 basis points to a rise of 50 basis points and levels in between. And those will be given by these figures here. And as you can see, the magnitude of the change is similar for a rise or fall because these are linear estimates. Now, just to see how good it is, we can go back and we can again calculate what the actual gain or loss would be based on recalculating specific prices on each of the bonds in the portfolio and calculating based on that what the actual gain and loss would be. And we see that for the portfolio as a whole, it's pretty close. And not surprisingly, that the bigger the yield to maturity change, the bigger the error. And then graphically, we can look at it this way. So what we're doing really with DV01 is we're using this linear measure, 7465, and we're measuring the gain or loss for small changes, which because the convexity isn't big for these small changes is actually a good estimate. As the gains or losses become larger, the convexity effect starts to apply, and we'll find that we'll be increasingly in error. Now, we can also use this to calculate modified duration. How so? So first recall that for a bond, modified duration measures the return from a small rise or fall in the bond's yield to maturity divided by that small change in yield to maturity. And that's given by this formula here. So the way we did it in the first tutorial on interest rate sensitivity is shown here. We took we previously calculated the PVBP of the bond, and we used that to estimate the return by dividing it by the price of the bond for a small 1 basis point move. And then we divided that return by the move itself. So we get a ratio of the return on the bond to the move. And that's our modified duration for a bond. Well, we can use that same technique using DV01 because DV01 represents the dollar change in the value of the portfolio. And we can get the return on the portfolio by dividing that dollar change, the DV01 of the portfolio, by the market value of the portfolio. That represents the return we would get from a 1 basis point move, and compare that to the 1 basis point move in yield. The ratio of the two is the modified duration on the portfolio. So let's look at an example. So here's our formula. And we're looking at our summary information again here. So we've got a DV01 of 7465 and the portfolio market value is 102,900. We don't have any bond level information at this point. And so we divide 7465 by 102,900. That gives us 0.0725%. And that represents what we would lose from a 1 basis point move in rates. And so the ratio of these two is the modified duration. 7.25 in this case. Now, there's an alternative way of doing this calculation if we didn't have the portfolio DV01. Suppose we had the individual bonds and we had their modified durations. So it turns out we can also calculate the modified duration by taking the weighted average of the individual bond modified durations. So how do we do that? So we have the market value for each of the bonds in the portfolio. We have the total market value. Based on that, we can calculate percent weights of each bond in the portfolio based on the market. So to take the first one as an example, the market value is 25,000. The total portfolio has a value of 102,900. So this first bond represents 24.3% of the portfolio. Similarly, for all the other bonds, we get these numbers. And if we add them together, they should equal 100%. Then we multiply this weight times the modified duration to get the duration contribution. And we sum those and we get the total duration of the portfolio, 7.25, which is what we got using the other method based on DV01. Now it turns out we can also use the same weighted average sum to calculate the Macaulay duration on the bond portfolio if we want to do that. And this should make sense because Macaulay duration itself is a weighted average of the sort of present value weighted of the cash flows of the bond. So if we're looking at the Macaulay duration of a portfolio, we then do the market weight sum of the Macaulay durations. And so we're using the same market value weights as we calculated before because that doesn't change, but now we're using the Macaulay duration instead of the modified duration, and we get the contribution for each of the bonds, sum them up, and in this case we get 7.77, which as expected, it should be a little bit above the modified duration of the portfolio. So bond portfolio losses now can be estimated from either DV01 or modified duration. We saw how it was done with DV01. Just to review that, we see it here. So we take the DV01 for the portfolio, 7465 times 25, for example, and we get 1866. This is estimating the loss from a 25 basis point rise. If we didn't have DV01 and we had modified duration, we can use a slightly more complex method, but not too bad. We have the modified duration of the portfolio. We multiply that by the YTM rise in basis points, but we have to convert that to percent by dividing it by 10,000. and then we multiply that by market value. And if we substitute these numbers in, 7.254 times 25 over 10,000 times the market value, we'll get the same 1866. Now you need to be careful that the precision is enough or that you haven't done rounding so that you'll get the same results. So now let's look at a slightly different type of portfolio, one where instead of being only long, we actually short one bond and long another bond. So remember, being short means that we sold rather than bought, and we sold something that we don't own. So that means that we will be harmed by a price rise and benefit from a price fall. So we represent that by showing its face value investment as negative. So suppose we have 250,000 invested in this 10-year 4% bond, and we have a short of 150,000 face of the 10.5% 10-year bond. And we have already calculated PVBPs on each of those bonds, so we can calculate the DV01 on each of the bonds. But since this is a negative investment, negative face value investment, we'll get a negative DV01. So that means the net DV01 on the entire position will be $26. So what does that mean? That means if the yield on each of these bonds rise by 1 basis point, the loss that we experience on this bond will be partially offset by the gain we have on this bond, or vice versa. So if we had a fall in rates, the gain we get on this bond, bond 1, would be offset by the loss we would have on the second bond. So the net exposure in this case is $26 to a parallel rate, same rate move on both bonds. Okay, so then that should raise the question of, well, how much should we short to exactly offset the DV01? In other words, to get a net DV01 of 0. So what we'd like to do is we'd like to have a face on the short position that delivers a negative 149 DV01 so that when we look at the net, we get 0. How do we do that? Well, remember the formula for DV01. DV01 essentially is PVBP scaled up by face value. So DV01 for the long position and DV01 for the short position. It's the same formula, but we'll use the L subscript and the S subscript to keep them straight. And we want the two DV01s to be equal. Okay, so we set them equal by doing this. We substitute in the expressions on the right-hand side for both, and we get the investment face of the short times this, investment face of the long times this. But what we want to know is we want to know how much to short. We know how much the long position is already, and we want to know how much to short. So we can do that by just rearranging this formula up here. So the divided by 100s cancel, and then we divide both sides by PVBPS, and that comes over here, and we get this formula here. And this ratio here, PVBPL divided by PVBPS, is the hedge ratio. So note it's kind of the reverse of what you're looking for. You're looking for the investment face value of the short position, and we need to take the ratio of the price sensitivity of the long, the PVBP of the long, divided by the PVBP of the short. And that's the hedge ratio, or the ratio of the short face to the long face. So let's apply that. So we've got this hedge ratio formula that we just calculated, and we've got this information here. We've got the two PVBPs, so we have what we need. So let's substitute 0596 in for the and 0820 in for the short, and we get a hedge ratio of 0.7268. So what that means is it means the face value that we need to short is that ratio, hedge ratio, times the face value of the long position. So we take that, our 250,000 long, times that ratio, and we get about 182,000. And so if we then make that our short position, and we'll have a short market value, but most importantly, we're looking for this to be negative 149. That's it for the third tutorial. Let's summarize our findings. So first, DV01 represents the actual dollars at risk per basis point, and it turns out to be very useful as we've seen for a number of applications. DV01 is like PVBP, but scaled to the actual face value held. So it's measured in dollars in contrast to the PVBP, which is expressed as a percent of face. The DV01 can be summed across a portfolio or a trading position. The modified duration for a portfolio can be estimated based on the DV01, just like we did for individual bonds using BVBP. And the portfolio summary statistics, DV01 and modified duration, give a very nice compact snapshot of its exposure to interest rate risks and interest rates, and can be used to measure sensitivity of the portfolio as a whole to rate moves. And finally, hedge constructed such the DV01 on the short position will offset the long position. And we showed how you could derive the hedge ratio so that you construct the hedge that will give you that net DV01 of 0. So that's it. Thank you for listening.